Hello everyone and welcome to CT Talks with Premier Brains. My name is Asher and in today's episode of knowledge sharing Q&A sessions on UAE Corporate Tax, the point of discussion would be on tax groups. I have here Ms. Bhavda with me.
Hi, hello everyone.
And she will be guiding us through the various concepts in the tax groups guide. On the 8th of January in the start of this year, the Federal Tax Authority issued the tax groups guide. Now this guide aims on guiding the taxpayers on understanding the basic taxation between two or more juridical resident persons that wish to form a tax group in UAE. Now this guide goes more in depth on understanding the eligibility criteria that needs to be satisfied in order to form a tax group, few exceptional conditions relating to tax groups, and how the taxable income shall be determined amongst the tax group members and the related compliance requirements. So now with that said, let's begin today's session with my first question to you. What is a tax group and the conditions for forming a tax group?
So, as per the UAE Corporate Tax law, a tax group is treated as two or more juridical resident person that are considered as a single taxable person for the purpose of the corporate tax. So, the parent and the subsidiary companies can make a joint application to the Federal Tax Authority if they wish to form a tax group, provided they are meeting the certain conditions. We are going to discuss what are those conditions, but primarily there has to be a parent and subsidiary relationship. Another important point is they have to be UAE juridical resident person. So by a juridical person, it means it has to be a separate legal identity. So for example, natural person cannot form a tax group, and foreign entities may be included in the tax group provided they are considered resident person by way of the effective management and control condition of the corporate tax law. Otherwise, they will not be able to be part of the tax group because if they are non-resident persons. So a tax group application needs to be thoroughly analyzed because there can be pros and cons of forming a tax group. Some of the pros can be in the form of filing a single tax return. There will be eligibility of eliminating the losses of one group member against the profits of the other group members, and also any transactions between the tax group members will get eliminated for the purpose of determining the taxable income of the tax group. Now let's understand what are the eligibility conditions. So parent and the subsidiary company can make application to the tax authority if they want to form a tax group, provided they meet these conditions. So one of the conditions which we discussed, that the parent and the subsidiary entity should be UAE juridical resident persons. The second condition is that the parent company must hold 95% of the ownership of the subsidiaries, either directly or indirectly through one or more subsidiaries. So ownership can be in the form of the share capital, voting rights, and the subsidiaries' profits. Another condition is that any exempt person or a qualifying free zone person cannot become a member of the tax group. And the last condition is that the parent and the subsidiary companies, which are the members of the tax group, must follow the same financial year and the same accounting standards. So these are all the eligibility conditions which needs to be met.
Okay. What is meant by the financial year condition and what does it imply to the members of the tax group?
So that corporate tax law states that the members of the tax group need to follow same financial year, which means they should have a same tax period. So if a if a member, changes the tax period, tax year, then ideally all the members will need to change the tax period simultaneously if they want to continue the tax group. Otherwise, if the one member does not align it with the rest of the tax group members, then the person will need to leave the tax group. The exception can be in the case of newly incorporated entities. So newly incorporated entities can join a tax group from the date of their incorporation, provided the end of their financial year is aligned with the rest of the tax group members. So they did not wait for the start of the next tax period. They can join from the date of the incorporation to the end of the tax period, which is aligned with the rest of the group members. So if there are entities which are able to meet the rest of the conditions, the eligibility conditions for forming a tax group, and only a financial year condition needs to be met, then they can also make an application to the Federal Tax Authority to change their financial year, which is consistent with the other group members, and the FTA may allow this, provided the extended period does not extend more than 18 months, or if it is not reduced to less than 6 months.
No. How do you describe the exempt person condition and the qualifying free zone person condition relating to tax groups?
So like when we were discussing about the eligibility conditions for forming a tax group, we discussed that exempt person and the qualifying free zone person cannot become a member of a tax group. So a qualifying free zone person, if they are not meeting the condition, if a free zone person is not meeting the condition of a qualifying free zone person and they elect to be subject to the normal corporate tax rate, then they can become a member of the tax group. So the restriction is only in the case of qualifying free zone person who are opting for the 0% benefit. And but this does not apply to a branch of a non-resident person which is registered in the free zone, because a branch is always considered as an extension of the head office. Does not have a separate legal personality of the head office, and since the head office is a non-resident person, they will not be able to meet the UAE resident person condition, which is one of the mandatory conditions to be able to join a tax group. So if the member of a tax group becomes an exempt person during the tax period, then basically the condition will not be met, the eligible condition for a member of the tax group. Then that person will be considered as leaving the tax group from the beginning of the tax period in which that event took place.
What will be the main responsibilities of the parent company of a tax group?
The parent company will basically be considered as a representative member of the tax group and will be responsible to meet certain obligations on behalf of the tax group. So this includes like submission of the tax group application. The parent company and the subsidiary companies will need to make a joint application to the tax authority for forming a tax group. Preparation of the consolidated financial statements of the tax group, which will be by way of aggregation of the financials of the subsidiaries and then eliminating the transactions between the subsidiaries. Then settling the corporate tax liability, filing the tax return for the tax group. Any application for corporate tax refund will also be the responsibility. And last but not the least is the providing of any sufficient documentation, maintenance of proper financial records, any transfer pricing documentation, etc. will also be the responsibility of the parent company. And if any clarification needs to be submitted to the Federal Tax Authority, that will also be the responsibility of the parent company.
What are the changes that can occur in a tax group and how shall all of them be addressed?
So the Corporate Tax Guide has given various cases where changes can occur a tax group. So when leaving a tax group, when joining a tax group, or there is a change in the parent company. So in all these cases, there will be changes in the tax group. So when a subsidiary company wants to join a tax group, there has to be an application made by the parent company to the Federal Tax Authority, provided the subsidiary meets the conditions for joining a tax group, and that the application will also need to specify the tax period from which the subsidiary will be joining the tax group, and then that application will get approved by the Federal Tax Authority once all the conditions are met. Another change can occur, like I said, when somebody is leaving the tax group. So if a subsidiary company is leaving the tax group, then again the application will be made by the parent company. It will be reviewed and approved by the Federal Tax Authority, and then that subsidiary will be considered as leaving the tax group from the beginning of the tax period which was mentioned in the application. Then subsidiary can also leave the tax group when it stopped meeting the conditions of the tax group. So for example, during the year, the subsidiary stops meeting the eligibility conditions of the tax group, then it will be considered to leave the tax group from the beginning of the tax period in which those conditions were not met. Then another case could be that the subsidiary company has transferred all its business to another subsidiary in the group. So in that case, that subsidiary stops to exist. So then obviously it will be considered as leaving the tax group from the date of the transfer, but the tax group can still continue to exist in this case. And in case of a change in the parent company, they can make an application for the change in the parent company. So for example, if a parent company is getting replaced by another parent company, then such application can be made to the tax authority in certain particular cases. So those conditions needs to be met. So there are various cases where a change can occur in a tax group.
How is the taxable income of the group members determined in a tax group?
So as a result of forming a tax group, basically the consolidated financials need to be prepared by the parent company, and the financial results of all the members of the group will need to be consolidated and reported as the taxable income of the tax group. So during this process, there will need to be elimination of the transaction which takes place between parent and subsidiary or amongst the subsidiaries themselves. So there will be a need to eliminate the transactions. Like I said, elimination of transactions can happen between parent or subsidiary or among the subsidiaries which are members of the tax group. But there are certain exceptions to this elimination rule. One such exception can be in the case of pre-grouping tax losses of any member of the group. So if any member of the group has any pre-grouping tax losses, then the elimination would not apply in such cases. Another case could be like there is a requirement that if there is any transfer of assets and liabilities among the members of the group, this will get eliminated. However, the gain or loss on such transfer will need to be recognized if either party leaves the tax group within 2 years of the date of the transfer. So these could be some of the exceptional conditions where the elimination will not need to be done.
What are pre-grouping tax losses and how can these be utilized to offset the taxable income of a tax group?
Pre-grouping tax losses are those tax losses which are accrued by any taxable person prior to them joining the tax group. And these will have a separate treatment because these can only be used to the extent of the taxable income which is attributable to that specific member of the tax group. So the amount of pre-grouping tax losses which can be used is lower of the amount of the taxable income which is attributable to the tax member which has the pre-grouping tax losses or 75% of the taxable income of the tax group. So whichever is lower amongst these two will be used for the pre-grouping, utilization of the pre-grouping tax losses. So it is important to note that the pre-grouping tax losses must be used to offset the taxable income before any other tax carry forward losses can be utilized in the same tax period.
In what situations will the taxable income attribution be required between the members of the tax group?
So the attribution can be required in certain cases where the member of the tax group has unutilized pre-grouping tax losses, where the member has earned a taxable income for which the tax group can claim a foreign tax credit, or where there are unutilized carried forward pre-grouping net interest expenditure. So in all these cases, the attribution of the income to a particular member of the tax group will be required. So in such cases, the taxable income will be calculated treating the person as a separate taxable person by using the group's accounting basis. Even in the case of the intercompany transactions, these will need to be determined consistently based on the arm's length principle. So these are some exceptional cases where the attribution of the taxable income to the particular members of the tax group will be required.
So with that said, we come to an end to today's episode of CT Talks with Premier Brains. I'd like to thank Ms. Bhavna ma'am for enlightening our viewers regarding the various topics in the tax groups guide. Stay tuned. We'll bring to you yet another episode of CT Talks with Premier Brains. We'll discuss another interesting topic about UAE Corporate Tax. Then thank you and have a nice day.
Thank you so much, everyone. Have a good day.